Hey everybody, Steve Ferguson here, your modern mortgage loan advisor. Thanks so much for tuning in today. Today we're going to talk about what happens with interest rates if the government shuts down. I've gotten this question asked so many times lately. How does it affect real estate? What happens with interest rates? I'm going to answer all those questions. But before I do, please like or subscribe to the channel. Please ask questions, drop comments, drop notes. I'd love to answer that stuff. It's a ton of fun for me, and I really enjoy helping you guys stay educated and making great decisions. And anyway, let's get started. So the government shut down. Congratulations. It's been shut down for, I think, 36 days now. So what does that do to mortgage interest rates? Absolutely nothing. It has no impact on interest rates because interest rates aren't based on the government being open. So here's what happens. Let's break this down a little bit to kind of a basic way of everything and how the operational pieces of it work. So interest rates are based on a couple different factors. Number one, the Fed. So the Fed sets what's called the Fed rate, and that is the rate for bank-to-bank overnight lending. So if Bank of America wants to lend to Wells Fargo overnight, that's the Fed rate, for lack of a better description. There's a lot more to it than that, but that's the basics of it, okay? So now Bank of America's got this loan from Wells Fargo, and they got to make money on it. So what they'll do is they'll mark up that interest rate, and they'll lend it out. So for car loans, for home loans, for whatever it may be. But there's other factors that affect home loans. So for example, mortgage-backed securities. So when a mortgage lender closes on your home loan, they put it in this big old pool, which means just a whole lot of other loans like yours, okay? They put it together and they put it on the open market and they try to sell all the servicing. So remember, most of these banks don't take your mortgage payments forever because that ties up their cash. So they'll put it in this big old pool. They'll put it on the open market and say, hey, I want to make some of my money back from servicing some of this. Somebody buy this. And then they'll see what the offers are going to be. Okay? Now, from an investor standpoint, there's lots of investors out there. And they're big guys, right? So it's not like you and me buying these. It's bigger corporations or retirement funds and all these other guys. They're looking for the greatest return on their investment. So, for example, if the stock market is really good, like it is right now, these firms that would normally buy mortgage-backed securities are buying stocks because it's getting them a better return. So the mortgage side of things has to make their portfolio more attractive. So what they do is they increase interest rates that you get on your mortgage loan to make their pool more attractive because it gets a higher return. Now, as an investor, I'm like, wait a minute, I like what you're selling to me here. I'm making more money on you guys than I am on some of these blue chip stocks. I'm going to move my money over to you guys. Now, what that does is when you've got a lot of demand for the mortgage-backed security side of things, we can lower our interest rate, which is what we're all hoping for, to get better interest rates. So that way, it helps all the homeowners out there. I don't have to be as attractive because the stock market's not doing as well over here. So therefore, I can sell my product at a lower cost. That's kind of the general idea of how mortgage rates work. Now, when we're looking at the government as a whole from a shutdown perspective, if you're doing any kind of normal loan, traditional financing, this really doesn't impact you unless you are employed by the federal government. That is a challenge because right now you're technically not, and verifying your employment would be very complicated since your bosses aren't at work either. Number two, it can affect you if you're a veteran. So again, veterans are paid by the federal government. Now, right now they are being paid, but if for some reason this lasted a long time and they stopped being paid, that would be a big challenge. Plus, we have to be able to verify their employment. That can be complicated. So that will affect you as well. It can also affect getting tax return information, such as from the IRS. So remember, we verify all kinds of income, your tax returns, etc., for using traditional financing. And in order for us to verify those things, we actually have to communicate with the IRS directly. Well, if nobody's there to talk to, nothing's happening there, that can definitely delay your closing. So that's the way that it can impact your mortgage loan itself. But it's not going to affect your interest rate or any of those things. If you're not employed by the government, it's not that big of a deal. If you're W-2'd, it's not that big of a deal. We just need to make sure that you filed your tax returns. So don't get caught up on this rigmarole and people saying these things. That's just is not how it works, man. This is a simple facts. This is how it's put together and made. And so the key for you guys is watch the market. If stocks are good, if employment's good, if inflation is pretty low, chances are rates may be a little bit higher. If employment's bad, stocks are bad, generally speaking, that's going to push rates lower, okay? So just some simple math there for you guys, things to watch out for. Any more questions, let me know. Drop any questions you have that I didn't cover in this quick video. Love to take care of that for you guys. Hope you have an awesome day. We'll talk soon. Bye-bye.